I think what's really important about the Phillips curve is it gets much more sensitive as you get into lower unemployment rates. And Michael reminded me of the period in '68 and '69 where we got to that 3.6% in the unemployment rate, and inflation took off. And where it peaked from there was a little crazy, but we really do think that this is going to start to be the story next year. I would think that the Fed has to start to react to inflation. If you look at this the New York Fed underlying inflation gauge, we think 4 hikes are pretty much something that the market needs to get comfortable with. And then I know we've had a lot of flattening in the curve, but I think a lot of that's been coming out of Europe and Japan, about a lot of flows into our treasury market, which is the other dynamic that I think might be even more powerful as far as where rates go next year. What the ECB has done as far as intervening in their bond market and driving things negative versus the amount of net issuance. So in the U.S., the Fed's never bought anything close to the net issuance in the treasury market. It's been a fraction of it. In Europe, it's been 7 times the amount of net issuance. So they have totally swamped their market and Japan's buying equities. But it is certainly a force to be reckoned with. Those tourists in our market have consistently driven the curve, flattening the curve about 60 basis points. So I think as we think about the tourists going home, and maybe out of Europe first, because of the PMI numbers come out. Today's PMI numbers that came out for November were very strong across Europe, a little softer here in the U.S. because of some of the hurricane effects, but certainly very strong there, and they're way behind the curve. So I think that's going to be another story that for 18 you start to see this technical dynamic where so much money has flooded into the U.S. Treasury markets and flattened the curve, maybe starts to abate.